Friends, I welcome you all. We are going to learn various types of audit. What is statutory audit? What are the other audits we normally deal with? Those things we'll be learning, and we'll be learning about advantages and disadvantages of audit. That is one more thing. What are the limitations of the auditing process? All those things we'll try to cover today. So let me share the screen with you. Or before that, we have already discussed earlier various types of audit, like something called as the statutory audit, something internal audit, let us say concurrent audit, stock audit, is it not? Let us say forensic audit. So these are the various terms we use in order to relate. Some of these audits are prescribed under law. They are called as the statutory audits. That means under some statute they have been prescribed. And some audits are voluntary. Voluntary audit. Okay, voluntary means the entity or the management of entity voluntarily decides to do that kind of audit. Okay, this is how broadly we can classify some audits as statutory and some audits as voluntary audit. Let me share the screen with you right now. Yeah. So coming to types of audit, as you can see, these are the list of some audits which are prescribed under law. Just have a look at all this. As you can see, audits required under law and voluntary audit. Audits required under law, if you see, first of all, all the companies are required to get their accounts audited. So that is the requirement of Companies Act. Company Act ensures that every company's financial statement gets audited. Similarly, there are requirements for banking companies under Banking Regulation Act 1949. Same type of requirement is also there under electricity supply companies, which are governed under Electricity Supply Act 1948. Cooperative societies, which are registered under Cooperative Societies Act 1912, are also supposed to get their accounts audited. Public and charitable trusts who are registered under various religious and endowment acts, maybe central act, maybe state act. If they're registered like this, they're also supposed to get their accounts audited. Corporations which are set up under an act of parliament or state legislature, such as life insurance corporations, etc., they are also required to get their accounts audited. And specific entries, that means the person may be an individual, maybe a company, maybe a firm, different types of entity are also required to get their accounts audited under the provisions of Income Tax Act 1961. Okay, the income tax law requires accounts to be audited if the turnover exceeds certain amount, 1 crore, 2 crore, like this in different situations. Accounts also required to be audited. So all these things you see, law requires or a particular act requires to get the accounts audited. Therefore, we can call all these type of audits as statutory. Okay, but apart from this requirement, people also voluntarily get their accounts audited, or entities voluntarily get their accounts audited, like maybe a proprietorship firms, maybe partnership firms, maybe Hindu undivided families. They also get their account audited. Okay, even if there is no basic legal requirement for this. Okay, some entities, as their internal rule, they decide that financial statements needs to be audited. Sometimes auditing is required as a direction from government. Governments may issue some directives that accounts needs to be audited when governments sanction some loans, grants, etc. So that may be a prerequisite. So this is how we can classify the audits broadly. Some of the audits are statutory audits, some of the audits are voluntary audits. Okay, hope you have understood this. Any query you have? So broadly, if you see, audits may be required under companies law, under income tax law, or some various other laws. All those audits will call it as statutory audit, and other audits will be calling it as voluntary audits. Now, this question may be coming to your mind, why there is voluntary audit? Voluntary audit is there because there are so many advantages of audit. If financial statements are audited, it gives a assurance that it shows a true and fair view, because an external expert is giving his opinion on that. Okay, that may be the primary motive to get the accounts audited, even when there is no statutory requirement. Right. So perhaps that is why a large number of proprietary firms or private businesses are getting their accounts audited. Okay. Now, having understood this broad classification of audit, now let us quickly learn what are the advantages of audit. Definitely, there is some positive utility in audit. That's why so many people, so many entities are getting their accounts audited, even if when there is no statutory compulsion. The chief utility of audit lies in reliable financial statements, on the basis of which the state of affairs of an entity can be easily understood. So friends, you know, the financial statements are very helpful to understand the business. One can understand the performance of an entity, one can understand the position of an assets and liabilities of an entity through these financial statements. Therefore, there is a need that these financial statements should be reliable. And auditing helps in developing, in ensuring the reliability of the financial statement. Okay, so that is the chief utility. But apart from that, there are many other advantages also. So we can see a list upon such advantages. First one, auditing safeguards the financial interests of the persons who are not associated with the management of the entity, whether they're partners or shareholders. You see, you take an example of a company. Practically, company is managed by the board of directors. All the shareholders may not be able to participate with the day-to-day affairs, day-to-day management of the company. So they have delegated this to the board of directors. And this auditing safeguards their financial interests. The auditing ensures that this board of directors are not working against the company. Same also in case of a partnership business, you can imagine. So all the partners may not be able to participate in the management. But if some partner is not able to participate in the management, he should be assured that his financial interests are taken care of. Auditing gives that kind of assurance. It safeguards the financial interests of the person who are not associated with the management of the entity. So even if they're not involved with the day-to-day activities, but their financial interests are taken care of. Okay, so that is one major advantage of auditing. Second is that auditing acts as a moral check on the employees from committing defalcations and embezzlements. So auditing sends a communication to the employees that the financial statement and in the process, the activities, the transactions of the company, the documents of the company are checked. Someone is verifying all these documents. Okay, so it acts as a moral check on the employees. So the employee will not be daring to commit any kind of defalcations or embezzlement. Okay, they will not commit any fraud, right? Because they get a message that all these transactions are getting to be verified, getting to be checked. Third thing is that audited statements of accounts are helpful in settling liabilities for taxes and also for negotiating loans and for determining the purchase consideration for a business. You see, when tax liability is to be settled, okay, at that time, audited accounts are more reliable. Because through these statements, through this audited financial statements, the profits or loss of the businesses are arrived at. So they are reliable. When they are audited, they are more reliable. So this is how the audited financial statements helps in settling tax liabilities. And also at the time of negotiating loans, when the financial institutes negotiate, okay, on a particular loan, maybe for doing something like one-time settlement for settling the loan or for writing off of a loan, they believe the audited financial statements to understand the financial position of an entity. So at that point of time also, audited financial statements helps in negotiation of loans. And also for assessing the creditworthiness of the organization, assessing the bankability of a particular project, audited financial statements are helpful. Audited financial statements are also helpful for determining the purchase consideration for a business. When the business is acquired in a merger, acquisition, or takeover deal, or when a new partner is admitted or if a partner retires from the business. This kind of situation, there is a need to assess the purchase consideration. At that time, audited financial statements plays a very important role. Okay, with the help of those audited financial statements, this purchase considerations can be compared. This is, you can say, the third advantage of auditing. Auditing also helps in settling trade disputes. If there is some trade disputes, let us assume some disputes between the workers' union and the management as regards to wages, bonus, etc. Normally, this kind of issues we see in many entities. For settling these kind of trade disputes in respect of damages suffered by property, fire, and for other calamities also, for all these areas. One is trade disputes can be settled with the help of audited financial statements. And for disputes relating to property damages, disputes relating to damages due to fire, calamity, etc. All these disputes can be settled through audited financial statements. Audit also helps in detection of wastages and losses. So in the process of auditing, all the transactions, all the activities of the entity gets checked. So this throws some light if there is some wastage, excess wastage or abnormal wastage, that also can be easily found out through ratio analysis, which is also done in the process of auditing. Okay. Now, next advantage is that auditing ascertains that whether the necessary books of accounts and allied records are properly kept up. So, you know, certain entities like companies, they're supposed to have some books of accounts. Minimum certain books of accounts needs to be maintained. Not only accounting books, other statutory books also, statutory registers and allied records also needs to be maintained. Whether they are maintained or not, that can be ascertained through an auditing process. Okay, when auditing is done, auditor verifies all these things also. Whether necessary books of accounts or allied records are kept or not, that can be checked through an auditing process. Next thing is that as an appraisal function, audit reviews the existence and operation of various controls in an organization and reports weaknesses and inadequacies, etc. If a particular internal control is inadequate, that inadequacy can be reported through auditing process. Or if a particular internal control is weak, when I say internal control, that means these are some controls which are, say, designed by management for smooth functioning of various operations. Okay, whether these controls are properly working or not. For example, suppose If something has to be purchased, voucher has to be approved by two persons. Let us say that is an internal control. The entity has developed that control. But actually that is operational, or there is some weakness in that control, or whether that is adequate or inadequate. These things can be appraised through auditing process. Next advantage is that audited accounts are of great help in settlement of accounts at the time of admission or death of partner. This I had discussed earlier also. So in a partnership business, when the partner gets admitted and the partner retires or dies, at that time also, for settling his account, for settling his capital account and his share of profit, audited financial statements are helpful. Government also may require audited and certified statements before gives any kind of assistance or before sanctioning a license for a particular trade. Therefore, auditing is also required, or auditing is useful. Okay, so these are, you see, 9 points we discussed, which talks about various advantages of an independent audit. Okay, if I list out this thing, if you see, this is the list. First of all, okay, chief benefit is definitely the reliability of the financial statement. In addition to that, you see, it safeguards the financial interests of the people who are not involved in the management. Then you see, it also acts a moral check on the employees, and for settling tax liabilities, negotiating loans, and purchase consideration, deciding purchase consideration, audited financial statements are helpful. For settling trade disputes, also audited financial statements are useful. For detection of wastage, auditing also helps in that regard. Another advantage is that whether necessary books of accounts are kept or not, that can be appraised through auditing function. Whether there is proper internal control. So about existence and operation of internal controls can be tested through auditing process. Accounts of partners can be settled, and government may require also to get the accounts audited. So requirements of the government can also be met through auditing process. So these are the advantages of an independent audit. Hope you have understood this. If you have any query, you may raise your hand. Okay, having understood this, now let us learn these limitations, or we call it as the inherent limitations of the audit. Inherent in the sense, these are limitations which are very difficult to avoid. It is almost unavoidable. Okay. So that's why we call it, it is inherent in the process of auditing. Okay. As you know, auditor is not expected to and cannot reduce the audit risk to zero. Okay, that means even if a particular financial statement is audited, cannot say it is 100% correct. No, it is difficult to say, because there is always still a risk. This audit risk cannot be reduced to zero. Therefore, auditing cannot give you an absolute assurance that these financial statements are free of any fraud, error, or mistake. Okay. Absolute assurances cannot be given. So what auditing gives is, in fact, auditing gives a reasonable assurance that financial statements are free from material misstatements. Okay, this material misstatements may be due to fraud or error, but there is a reasonable assurance that these financial statements are free of that. Okay. So if you refer standards on auditing, say 200, that overall objectives of independent auditor and conduct of an audit in accordance with the standards on auditing. That standard discusses something like what is the nature of financial reporting. That particular standard identifies some of the inherent limitations. And according to that standard, these inherent limitations arise from these these points. First of all, nature of financial reporting. The nature of financial reporting is such that it creates a limitation for the audit. Because financial statement itself, preparation of financial statement involves some assumptions, estimations, judgment. So very nature of the financial statement is such that the audit risk cannot be reduced to zero. The nature of auditing procedures, that also will be learning. Whatever audit procedure you may adopt, but you cannot give guarantee that all the misstatements are detected 100%. No. The nature of audit procedures are such that there will be some inherent limitations. Then the timeliness of financial reporting and the balance between benefit and cost. The financial reporting needs to be completed within a time. So within certain time, auditing needs to be completed. Okay. So if you go for a kind of absolute assurance, then it may be a very time-consuming exercise. And also it may not be cost-effective. So that consideration of time and consideration of cost also contributes towards inherent limitations of audit. There are other matters also, like possibility of error, fraud, which also affect the limitations of audit. So these are, you can see the 4 sources which are highlighted in essay 200, which contribute towards limitations of audit. So one by one, we'll discuss all of them. First of all, first source is that the nature of financial reporting. As I was telling you right now, the preparation of financial statement involves judgments. Management applies judgment. Okay, whether a particular liability is there or not, whether provision is required against a particular asset, right? And what will be the life of an asset. These are the examples of some areas where management exercises their judgment. And when it involves judgment, it is practically very difficult for the auditor to verify the accuracy of that judgment. Okay, so all these are the areas where the management applies its own judgment in preparing the financial statements. Okay, and again, the financial statement items involve subjective decisions or assessments or degree of uncertainty, and there may be a range of acceptable interpretations and judgments. Right, when financial statements are prepared, many subjective decisions are taken, and many assessments are also made by the management in the situation when there is uncertainty. Okay, let us say a provision for bad debt has to be made. It is an assessment. Management has to assess. And therefore, there are so many situations where there will be a range of acceptable interpretations or judgments. So different people may say different things are right. Someone may say, no, we'll recognize it as a revenue. Someone say it may not be. We should not recognize it as a revenue. There may be a range of interpretations which will affect the preparation of financial statements. So because of this thing, because of judgments, because of subjective decisions, because of assessments, because of degree of uncertainty behind these financial figures, and because of possibility of range of acceptable interpretations, auditing cannot give an absolute assurance that the financial statements are giving a true fair view. Okay, therefore, because of this very nature of financial reporting, there will be some inherent limitations of auditing. Second reason or second ground of inherent limitations of audit is that nature of audit procedures. Auditor applies certain audit procedures to ensure that the financial statements are actually showing true and fair. but there are issues in it. First of all, there is a possibility that management may not provide the complete information which is relevant for preparation of the financial statement. If that information is there, then auditor may test it. Suppose financial transactions are there, auditors are verifying these financial transactions and ensuring that books of accounts are drawn in accordance with the financial transactions. Books of accounts are transactions are recorded in the books of account, and financial statements are drawn with reference to the books of accounts. Like that, auditor can check. But if a complete information is missing, for example, suppose an entity has received a notice from an authorities for levy of a penalty. Entity has only received the notice and entity has not disclosed that notice to the auditor. How auditor will ensure that against that notice whether liability provision has been made or not? Okay. If incidentally it comes to the notice of the auditor may check it. Otherwise, how auditor will know that this particular company and the particular entity has received a notice? So this is an example when auditor may not get complete information. That is one thing. Second, inherent limitations related to audit procedure is that if there is a fraud, this fraud might have been organized in a very sophisticated manner and through some carefully organized schemes. And auditors' normal audit procedure may not be able to detect that fraud. That fraud may not be detected. Okay. Therefore, audit procedures used to gather audit evidences may be ineffective for detecting an intentional misstatement that involves a fraud. Auditor is applying some audit procedures, but they are normal audit procedures to detect an error. Okay, but a carefully if fraud is carefully planned or carefully organized, then this audit procedure may not be able to detect. Okay, for example, suppose there is a collusion between employees. 2 or 3 employees join together and they commit a misstatements. Right? For example, internal control system ensures that if a payment has to be made for a purchase, then one person has to give requisition, another person has to approve. Okay. Then after that, purchase order has to be made. Then item will come, it will be entered in the stores. Then bill will be received, bill will be passed by some other person. Finally, payment will be released by some other person, and accounts will make an entry for that. So many people are in, but all of them, let us say, join here. They can enter totally a fake transaction. They will generate an artificial, let us say, requisition, artificial approval. Okay, they make an entry in the goods stock register. They may raise a fake bill. Payment may also be released because all the people have joined hands. Auditor may check all these documents, everything is fine. Auditors can see, okay, the particular item has been purchased. There is an entry in the stock register. There is an entry, let us say, goods inward register. Purchase bills are there, payments are made, approved by some other person. So in this situation, your normal audit procedure may fail to detect this kind of frauds. So this is again an example of inherent limitations of audit. And since auditing is not an investigative activity, no investigation is in fact involved in the auditing, auditor is also not given any specific legal power to conduct investigation. So that is one more weakness. So auditor will check the transaction, satisfy himself that the financial statements are showing true and fair view. But many times his own procedures may fail. Now, third source of inherent limitations of audit is that timeliness of financial reporting and the balance between benefit and cost. The matter of difficulty, time, or cost involved is not in itself a valid basis for the auditor to omit the audit procedures. Of course, auditors will not omit a procedure just because it is difficult, or just because it doesn't have time, or just because it involves a cost. So what is expected, auditors has to make an appropriate planning so that once the procedure is decided, that has to be applied. Okay, but that will happen only when auditor plans it. Okay, in absence of planning, it may be very difficult to complete the auditing within the time limit. Okay, sometimes auditor may feel that the issue involved or the amount involved may not be material to incur so much of cost. So on the basis of cost and benefit analysis, auditor may select a audit procedure which may not be efficient. So there are chances. Okay, so because of this timeliness of financial reporting and the balance between benefit and cost, okay, because of these aspects, there are some inherent limitations of audit. Okay, absolute accuracy cannot be ascertained. It involves a cost. And if auditor decides not to incur that cost, that becomes a limitation. There are other matters also that affect the inherent limitations of the audit. First of all, if there is a fraud, where senior management is involved, or there is a collusion example I have given you. But if senior management is involved, let us say senior management has given direction to commit a fraud. Senior management has given a direction to make a fake entry in the books of accounts. So with proper approval, this entry has been made. Auditing procedure may fail to detect it. And there are other matters like other matters are also there, like existence and completeness of related party relationship and transactions. Whether management has disclosed complete information about related party transactions or not. That affects the limitations of audit. If management has not given disclosure, then audit procedures may not be able to detect that. How can an auditor will know that what are the transactions which may be related parties? So that affects. Then occurrence of non-compliance with laws and regulations. If a particular law has not been complied with, auditor may not be able to detect. So in the process of each auditing procedure, if auditor is aware of some laws and regulations which are supposed to be complied, auditor will be checking that. But there are so many laws and regulations which needs to be complied. And when auditor is involved with the financial auditing, he may not get a chance to verify that all the laws and regulations which are applicable to the entity are complied with. Right? Auditor, let us say, is verifying the financial statement. So he may check that, let us say, suppose a particular payment has been made. He may check whether TDS has been deducted or not. The compliance of income tax law he can, or let us say salary payment has been made. He can say whether PF Act is complied or not. Like this, some laws and regulations which affects the financial figures, he may check that. But some other laws and regulations, auditor may not be knowing. Suppose that particular industry requires some specific approval, specific license. Auditor may not be knowing that. Therefore, it contributes towards inherent limitations of audit. That future events or conditions that may cause an entity to cease to continue as a going concern. So there might be some future events or conditions which may affect the going concern assumption of an entity. Auditor may not be able to know that thing also. Right? You see, financial statements are prepared on the basis of certain assumptions. One of that assumption is the going concern. But there might be some future events which affect that going concern assumption. Entity may cease to operate. In that case, the basis on which the financial statements are prepared may not be correct. Auditor may not be able to recognize that future events and conditions. So these are using certain inherent limitations of the audit which auditor needs to take care of. Okay. And if you see the limitations which are affecting the scope of audit, first of all, you see, when auditing is done, the procedures that are applied, they are of test nature. That means auditor tests certain transactions. It may not be possible to test the entire transaction. Okay, let us say certain vouchers are selected, certain transactions are selected. So, because of the test nature of audit, there are limitations. Then, when we are discussing now the inherent limitations of judgment, limitations of audit, when doing the auditing, auditor exercises his own judgment. And when he exercises the own judgment, on that basis, he draws a reasonable conclusion. Okay, auditor judges the transaction and he concludes that whether the transaction is genuine or not, whether the transaction is fair or not. Okay, reasonable conclusions, what a normal person can see. Suppose auditor is seeing that the money has been paid to someone, a voucher has been signed, auditor can draw a reasonable conclusion that it has been paid, money has been paid. But if that signature is fake, auditor may not be able to detect that. Because auditor can only draw a reasonable conclusion, not absolute conclusion. And again, the evidences which are collected by auditor are persuasive in nature. That way, it will pursue the auditor to believe that the transaction is true. But they are not conclusive. Persuasive, they are not conclusive. One cannot conclude that the transaction is actually genuine. To conclude that thing, one have to investigate. And auditor is not doing that investigator's job. So these are the inherent limitations which affect the scope of auditing. Meaning auditing involves exercise of judgment. Auditor can only draw reasonable conclusions. And the nature of evidences are persuasive. Now, in addition to that, in addition to these limitations of audit, there are inherent limitations of internal controls also. When auditor conducts an audit, he relies on the internal control system of an entity. Okay, first he tests the internal control system, whether it is working properly or not. And if it is working, he relies on it. But that internal control system itself has got some limitations. Internal control system may fail to operate in certain situations. And internal control system may be ineffective if there is collusion. If people join hands, if there is a collusion among employees, internal control system may not operate. And there might be certain positions in an entity who are capable of overriding controls. Let us say top senior management. They may override the controls. They may give direction to do something, to record a particular transaction in a particular way. They're overriding the controls. So these things also All these are, in fact, the inherent limitations of the internal control, which affects the limitations of audit. Okay, these things what I told you, all these things are written here. Okay, so now if you see, coming to inherent limitations of audit, there are inherent limitations of audit itself, and there are inherent limitations of internal control system. And this inherent limitations of internal control system also contributes to the inherent limitations of audit. The inherent limitations of audits are, it involves judgment. Auditor can only draw reasonable conclusions, and the evidences are persuasive. And inherent limitations of internal controls are there. It may fail to operate. There may be collusion among employees. There might be involvement of top management. There might be positions overriding to control. All these things contributes towards inherent limitations of internal control, which in turn contributes to the inherent limitations of audit. Okay, is it clear to you? Quickly, let us learn one more aspect, that is how auditing is related to other disciplines. Auditing and accounting are very closely related. As you know, the financial statements which are audited, they are the end result of the accounting process. So that is how auditing is auditing is connected to the accounting. Without accounting, financial statements may not be prepared, and auditor may not be able to get them audited. Auditing is also related to the subject law because it involves examination of these financial items, financial assets, liabilities from legal point of view. Auditing also connected with the subject of economics, because when auditor audits or gives an opinion on the financial statement, whether it is showing true and fair view, is expected to be familiar with the economic environment in which the client is operating. So in that economic environment, whether the financial statement which is prepared, that is reflecting the true and fair view or not, that opinion auditor should give. So understanding the economic environment is important for auditor. Therefore, auditing is connected with the subject economics. And in the process of auditing, auditor has to deal with many people. So the knowledge of human behavior, how to deal with people, how to extract data from them, is important. In that context, auditing is also related to behavioral science. In the process of auditing, auditor collects data, analyzes the data, and he make many kind of statistical analyses. Okay, he may do test check on certain on data figures. Therefore, auditing is connected to the subject statistics and mathematics. The subject data processing also closely related to the auditing. Auditing, the result of audit procedure is dependent upon the accuracy of the data that he is having. So many times auditor draws a conclusion by processing the data, by using system or appropriate programs and appropriate softwares. So the data processing subject is very closely related to the auditing. Knowledge of financial management is also important. The techniques we apply in the financial management for taking decisions, whether it is investment decision, financing decisions, or dividend decisions. Accuracy of the decisions, or the true and fairness of the decision is evaluated by auditor. Therefore, knowledge of financial management is also important. Auditor is also supposed to have knowledge on production system, cost system, marketing, personnel management in all this area. So therefore, there are various subjects are there which are closely related to the auditing. Okay, So, friends, today we covered uh, these few concepts. So we covered what are the various types of audit, what are the advantages of audit, what are the inherent limitations of audit, how it is related to the inherent limitations of internal control. Then we also covered how auditing is related to other disciplines. Okay. Then few other concepts are also there, like standard setting process, how auditing standards are set. These things we'll be learning in our next session. If